Saurabh, good morning to you. Obviously, the big news that everyone needs to, take heed of and probably address at this moment is what's been happening, with the government and the RBI. And what has your reading been into this, and how could this have its repercussions?
Look, these are exceptional circumstances, and exceptional circumstances call for exceptional measures. So I think some of what we are seeing playing out between the government and the RBI is a byproduct of the huge amount of liquidity that NBFCs and housing finance companies need over the next month or so. I think just between now and 10th November, the NBFCs and HFCs need around 50,000 crores because that's the amount of CPs that is rolling over. It's unlikely that the mutual fund industry will supply that liquidity to the NBFCs, which is where the banking system comes into play. The banking system is the purview of the RBI, and hence this clash of titans between the finance ministry and the RBI. So, exceptional circumstances, interesting circumstances. Let's see how things play out over the next 10-15 days.
At standpoint, Saurabh, what should market watchers be looking out for, and what are you factoring in terms of whether you change your stance or no?
Look, I've been saying the same thing for the last 12 months, that it makes no sense to have so much of your money invested from an equity perspective. It makes no sense to have so much of your portfolio in wholesale funded lenders, whether they be HFCs, NBFCs, or indeed the wholesale funded banks. Our system simply cannot justify this sort of valuations for wholesale funded lenders. The point of view continues. I think it's simply not feasible to believe that the NBFCs and HFCs can continue getting these massive amounts of liquidity from the wholesale market on a steady basis to fund assets which are anywhere between 5 years to 20 years in tenor. So you're borrowing from the wholesale market, lending very long term, and that asset liability mismatch is not tenable. You can buy these entities, but at valuations of well below price to book of 2 times. I think only one large HFC has reached 2 times. The rest of them are still trading at absurd valuations.
Saurabh, good morning. Neeraj here. And firstly, thanks so much for agreeing to talk to us on such a short notice. The news, Saurabh, that we have at hand is that Section 7 hasn't been invoked, but the government has issued letters to the RBI to initiate consultation under Section 7. That by itself isn't the most pleasing of news, right? That at such critical times, you have the government and the RBI at such great loggerheads that this act needed to be done in the first place. Does it make the money markets more nervous? Because I remember your comment on the policy day that if you were a trader on the overseas markets, you would essentially go on short the rupee and make merry. The rupee has started off weak in today's session as well, arguably bogged down by this news.
Look, I'm nobody to comment on whether the government has done the right thing or wrong thing
whether or not the signal that it gives to the market, Saurabh.
Yeah, but I think just focusing on the underlying challenge. The underlying challenge is we're funding our economy through wholesale market funded lenders, HFCs, NBFCs, and wholesale market funded banks. Our wholesale markets simply do not have the wherewithal to sustain this sort of funding on a non-stop basis for long-dated assets. So there's an underlying fundamental challenge. That challenge is going to come to the fore over the next 4 to 6 weeks, because massive amounts of CPs are gonna come up for maturity, and it'll be interesting to see whether the NBFCs and HFCs can replace the CP funding with something else. I can't see how they'll roll the CP over. I can't see how the mutual funds will buy fresh CPs. So clearly there'll have to be a replacement of that funding with something else. The logical something else, the logical new source of funding will be banks lending heavily to NBFCs and HFCs over the next 4 to 6 weeks. Will it happen? I think the jury is still out. And that's where I think the government versus RBI clash is so decisive. I think that's where the central bank, I think, probably try to exert a degree of restraint on bank lending to NBFCs and HFCs, and perhaps that restraint might prove to be challenging to practically exert.
Saurabh, if indeed the news were to come to the fore, you think there is a larger negative repercussion for the equity markets? Because I must add that the Indian market, I mean, not that you wouldn't know about it, but compared to the rest of the Asian screen or the global screen, Indian markets are fairly subdued today, arguably on account of this news flow.
I think again, for the last year, I've been saying Indian markets overvalued. The overvaluation is corrected somewhat, but I would say Nifty 9,500, roughly around there, would be fair value for the Indian market. And as we've discussed before, I think the rupee has got further to sink. So I would be cautious of the market as a whole. I would stay away from wholesale funded lenders. There is value to be had elsewhere in the Indian market, in IT companies, in pharma companies, in some of the export-related franchises. But wholesale funded lenders in India, precarious territory to be in for the last 12 months, precarious territory to be invested in even today.
From a market standpoint, Saurabh, leaving this bit of news aside, and we'll come to it when it actually unfolds and how the market reacts to it then. But we're in the midst of the earnings season. So far, what is your assessment of the earnings season been in terms of the expectations, beat, meet, and the ones that have not been able to match up?
I think it's been little below expectations. I don't think it's some radical. I don't think there are radical surprises there. But I wouldn't focus too much on the earnings season. I think H2 will look very different from H1. H2 will look very different from H1 because the funding crunch clearly is kicking in. You can see it in auto loan demand, cars, trucks, bikes, and as the funding crunch kicks in, we will see a more subdued economy in the second half of the year, which will obviously have an effect on earnings growth. So I wouldn't kill myself, passing the Q2 numbers for some forward-looking deals.
But if you had to probably pinpoint a pocket which has surprised you on the positive side the most, which would that be so far from the larger ones that have already come out?
I think IT, I said a year ago, IT looked very attractive. It's a good run. I think there's more to go in IT. There's more juice left in IT. We will see very pleasing results from the IT sector for the next 3-4 quarters. I think pharma as well. The rupee sliding is a big boost for the pharma sector. We'll see pleasing results there as well. And I think pharma stocks are overdue a substantial recovery.
Okay, Saurabh, just one final question from my end, and that is on something that I've heard now 2 or 3 fund managers start talking about. You're referring to financials in a big way. Is it now time to start looking at even financials from the bucket of retail versus industrials, and maybe time for the industrials or the corporate-facing financials to now come to the fore, as opposed to the retail-facing financials, which have enjoyed dominance for the last 6 or 7 years, at least, if not more?
I wouldn't draw a distinction between industrial, retail-facing. I think those are facile distinctions to draw. I think the distinction is: are you a bank with a strong CASA franchise? Do you have a strong liability franchise? Or are you a lender who relies heavily on wholesale markets? If you are the latter, your growth prospects will be limited in India over the next couple of years. If you are the former, you have a strong liability franchise, a strong CASA franchise, you will have good growth prospects in India over the next couple of years.